How to make a budget. If I have take-home pay of, say, $2,000 a month, how can I pay for housing, food, insurance, healthcare, debt repayment and fun without running out of money? That's a lot to cover with a limited amount, and this is a zero-sum game. The answer is to make a budget. What is a budget? A budget is a plan for every dollar you have. It's not magic, but it represents more financial freedom in a life with much less stress. Here's how to set up and then manage your budget. But before we begin, please subscribe to our YouTube channel for such amazing and informative videos. Understand the budgeting process. Figure out your after-tax income. If you get a regular paycheck, the amount you receive is probably it, but if you have automatic deductions for a 401k, savings, and health and life insurance, add those back in to give yourself a true picture of your savings and expenditures. And health and life insurance, add those back in to give yourself a true picture of your savings and expenditures. If you have other types of income, perhaps you make money from side gigs, subtract anything that reduces it, such as taxes and business expenses. Choose a budgeting plan. Any budget must cover all of your needs, some of your wants and, this is key, savings for emergencies in the future. Budgeting plan examples include the envelope system and the zero-based budget. Track your progress. Record your spending or use online budgeting and savings tools. Automate your savings. Automate as much as possible so the money you've allocated for a specific purpose gets there with minimal effort on your part. An accountability partner or online support group can help, so that you're held accountable for choices that blow the budget. Practice budget management. Your income, expenses and priorities will change over time, so actively manage your budget by revisiting it regularly, perhaps once a quarter. If you're struggling to stick with your plan, try these budgeting tips. Try a simple budgeting plan. We recommend the popular 50-30-20 budget to maximize your money. In it, you spend roughly 50% of your after-tax dollars on necessities, no more than 30% on wants, and at least 20% on savings and debt repayment. We like the simplicity of this plan. Over the long term, someone who follows these guidelines will have manageable debt, room to indulge occasionally, and savings to pay irregular or unexpected expenses and retire comfortably. If your absolute essentials overshoot the 50% mark, you may need to dip into the wants portion of your budget for a while. It's not the end of the world, but you'll have to adjust your spending. Even if your necessities fall under the 50% cap, revisiting these fixed expenses occasionally is smart. You may find a better cell phone plan, an opportunity to refinance your mortgage or an opportunity for less expensive car insurance. That leaves you more to work with elsewhere. Leave 30% of your income for wants. Separating wants from needs can be difficult. In general, though, needs are essential for you to live and work. Typical wants include dinners out, gifts, travel and entertainment. It's not always easy to decide. Are restorative spa visits, including tips for a massage, a want or a need? How about organic groceries? Decisions vary from person to person. If you're eager to get out of debt as fast as you can, you may decide your wants can wait until you have some savings or your debts are under control. But your budget shouldn't be so austere that you can never buy anything just for fun. Every budget needs wiggle room. Maybe you forgot about an expense or one was bigger than you anticipated, and some money to spend as you wish. Commit 20% of your income to savings and debt repayment. If there's no money for fun, you'll be less likely to stick with your budget. Use 20% of your after-tax income to put something away for the unexpected, save for the future and pay off debt. Make sure you think of the bigger financial picture. That may mean two-stepping between savings and debt repayment to accomplish your most pressing goals. Calculate your net income. The first step is to find out how much money you make each month. You'll want to calculate your net income, which is the amount of money you earn less taxes. If you receive a regular paycheck through your employer, regardless if you're part-time or full-time, the amount listed is likely your net income. Keep in mind that if you're enrolled in a health insurance plan, flexible spending account, FSA, and/or a retirement account through your employer, you'll want to subtract those deductions to make sure you have a clear picture of your take-home pay. If you freelance, are self-employed or simply don't receive a regular paycheck, you'll need to subtract taxes from your income amount. The self-employment tax rate is 15.3%, according to the IRS. You can use this Tax Act calculator to estimate how much taxes you're required to pay in a year. Then you can divide by 12 to get a monthly estimate. It's also good to include details on how much you're saving each month, whether that's into traditional or high-yield savings accounts or a personal retirement account, such as a Roth IRA. Label fixed and variable expenses. Once you've compiled a list of your monthly expenses, label whether they're fixed or variable. Fixed expenses are bills you can't avoid: rent, utilities, transportation, insurance, food, and debt repayment. Variable expenses tend to be more flexible: your gym membership, for instance, or how much you spend on dining out. If money was tight, you could always drop your gym membership and curtail your dining out spending, but you are likely always going to have to pay rent or your mortgage. Determine average monthly cost for each expense. After you separate fixed and variable expenses, list how much you spend on each expense per month. You can look up your spending on bank and credit card statements. Fixed expenses are easier to list on your budget than variable expenses since the cost is generally the same month to month. For example, debt repayment on a mortgage or auto loan will cost the same each month. But fixed utilities, such as electric and gas, and variable costs, such as dining and household goods, often fluctuate month to month. So you'll need to do some math to find the average. For these categories and anywhere your spending changes from month to month, determine the average monthly cost by looking at 3 months' worth of spending. To calculate the average amount you spend on groceries, for example, add up all of your grocery spending during the past 3 months and divide by 3. If you find that the average you spend on groceries each month is $433, you may want to round up and set the spending limit to $450. Make adjustments. The last step in creating a budget is to compare your net income to your monthly expenses. If you notice that your expenses are higher than your income, you'll need to make some adjustments. For instance, let's say your expenses cost $300 more than your monthly net pay. You should review your variable expenses to find ways to cut costs in the amount of $300. This may include reevaluating how much you spend on groceries, household goods, streaming subscriptions, and other flexible costs. It's a good idea to reduce these costs and regularly make adjustments to the amount of money you spend so you can avoid debt. On the other hand, if you have more income left over after listing your expenses, you can increase certain areas of your budget. Ideally, you'd use this extra money to increase your savings, especially if you don't have an emergency fund. But you could also use the money on non-essential things like dining out or traveling. If you don't yet have a high-yield savings account, consider opening one. Such as Marcus by Goldman Sachs High-Yield Online Savings, and earning 16 times more interest than traditional accounts. If you like the content of the video, please give it a thumbs up and comment down your thoughts on this. Want more amazing videos? Subscribe to our channel and get more fantastic videos to watch. Thanks for watching till end.